In this video, I'll be showing you how to read the non-farm employment change data, or the US jobs report, and more importantly, how this report can impact the US dollar, gold, and stocks. Let's get started. So if you're new to the channel, do me a big favor, hit the thumbs up button and subscribe if you're looking to learn more about trading the financial markets. Specifically today, we'll be taking a look at the non-farm employment change data, or the NFP report, that comes out once a month on the first Friday of each month. Now, why is it specifically then? Well, the first Friday is the official date that they usually do this for the previous month. So in this case, we're looking the April 2025 release, but this is actually going to be telling us about March data. Now again, on the first Friday of each month, we report the previous month's jobs numbers. So the way we would read this is that on April 4th, we got March jobs data. So what you'll see is we have three main statistics to take a look at. We have the average hourly earnings, we have the non-farm employment change, and we have unemployment rate. So in this video, I'll be mapping out what each of these key statistics is, and more importantly, how it could impact your charts if you're an active trader or investor. Let's start with the big one. Non-farm employment change is basically the number of jobs added, excluding the farming sector of the economy. And this is because that portion of the economy can really skew the data. So we really just strip that out and we take a look at the raw jobs added in the previous month. Now, what you'll notice is you get three key statistics here. You get the actual number, the forecast number, and the previous number once this data releases at this point, 8:30 on Friday of April 4th. So the way we would read this report is that the actual data came in at 228,000 jobs added in the month of March. And that number is compared to the forecasted value of 137,000 jobs. Well, where did this number come from? Well, economists and the analyst community put together their best forecasts based on mathematics, calculations, estimates, all sorts of things to try and predict what this jobs data point is going to come out and finalize as. So the key thing you want to notice here is that the forecast was 137,000 jobs would be added in March of 2025, but instead we actually got 228,000 jobs added. So the way we would report this is that the actual data came in higher than forecast, which is a good thing for the US economy. This final number is the previous reported number. So this would be not March's data, but February's data, which came in at 117,000 jobs. The next thing we'll be taking a look at is the unemployment rate, which is simply the rate of unemployment within the population looking to get jobs. So what you can see here is that we have a actual forecast and previous once more, and we have a 4.2% actual number that came out compared to 4.1%. What you'll notice is that this number actually came in higher than expected, and you can see that Forex Factory, which is the website that we're on, forexfactory.com, came in red. Why did it come in red if the number was higher? Well, that's because this is perceived as a negative thing for the US economy. Higher rates of unemployment are considered bearish or negative for the economy, and lower levels of unemployment signify that there's a stronger labor market and more people are employed. And then the same scenario here, the previous number was 4.1%, so we went up in unemployment rate in the actual data. The final statistic is the average hourly earnings month over month, and this is of course people's wage growth. When you have a strong labor market, typically prices of labor do tend to go up. So when there's very strong economic growth, typically people get raises more frequently and more aggressively. And in weaker economies, we would see the opposite as people get laid off or companies simply cannot afford to raise wages. Now, we just went through a lot of stuff, so feel free to pause and rewind the video if you need to. But now we're going to talk about these three statistics and how they can impact the US dollar, gold, and stocks. First, let's do non-farm payroll, which, as a reminder, is basically the number of jobs added in the previous month. And let's say that NFP, or non-farm payroll, came in much better than expected. Now remember, we're looking at actual versus forecast. So if the actual data came in better than the forecast, we would consider that to be a strong NFP report relative to analyst forecasts. In the event that we have a strong NFP report, the US dollar would likely strengthen, as that is a reflection of a stronger jobs market and hence a stronger US economy. As for gold, a stronger US dollar and a more stable economic outlook is perceived as negative for gold, as in that case, again, people usually flock to gold when there's uncertainty and economic weakness. but the opposite is also true. When you get a strong jobs report, it's typically not perceived as a bullish thing for gold. For stocks, this is also a positive thing, as more employment means consumers are likely at a more stable spot and can go out and spend more money, hence adding to the potential earnings of key companies in the US economy. If we were to reverse this number and said we had a weak NFP report, basically meaning that the actual data came in less than the forecasted value, we would consider that to be bearish for the US dollar, bullish for gold, and bearish for the stock market. A key note on gold on this front is that when you have weakness in the jobs market, that makes people more attracted to a safe haven asset like gold, which can potentially protect them in the times of economic uncertainty. Next, let's take a look at unemployment percentage. Now, don't get too confused by the colors, but let's say we get a rise, which would be a negative thing in terms of the state of the US economy for unemployment percentage or unemployment rate. This would be bearish for the US dollar, and it would also obviously be bearish for stocks as well, as people losing jobs means the consumer may weaken and have less ability to spend money. Conversely, gold would thrive in this period of uncertainty. And if unemployment percentage or unemployment rate went down, we would consider this to be a strong thing for the US dollar and a strong thing for US stocks. But in this situation, it would be negative for gold. Again, because the uncertainty would be diminishing, that would be less attractive for gold as an alternative investment. Let's now do wage growth. Let's say that wage growth is strong and people are getting aggressive wage increases month over month and year over year. This would be showing a strong US economy because, again, wages increasing means the demand for labor is strong. This would be good for stocks and good for the US dollar. Conversely, this would be negative for gold. And when we flip everything around and say wage growth is diminishing, that would be bearish for the US dollar, bearish for stocks, and bullish for gold. Please feel free to pause the video and mark this down on a piece of paper if you'd like for future reference. Now, there is a side component that we need to discuss just briefly, which I have more videos on my channel, which again, if you're enjoying this video, consider subscribing if you're new. Interest rates and inflation play a key role in completely screwing up this chart. Let me give you an example. If inflation is running out of control, like it was in the year 2022, and interest rates are rising aggressively, inflation can actually be increased by a strong jobs market. In fact, oftentimes the Fed wants to weaken the jobs market slightly in order to get inflation under control. Because again, when people get wage increases aggressively, that can lead to them spending more money, causing inflation to rise further. So this idea is that we actually want to consider this chart for the most part, but if you get a sharp rise in interest rates and inflation from the Federal Reserve, there is something that we need to discuss, which is basically if these things are on the rise. Let's say that we have very strong inflation, like inflation is rising and the Fed is worried about inflation getting out of control. These statistics start to change for the stock market. Specifically, if we get high levels of wage growth and jobs data and unemployment rate, typically we see that as a positive catalyst for stocks. But in the event that we see inflation rising dramatically, this actually all flips to the other direction. What I mean by that is that if the Fed is worried about getting inflation under control, they may need to continue to hike interest rates, and rising interest rates are usually perceived as negative for stocks as borrowing costs start to go up and negatively impact consumers and businesses. So in that event, when we see high levels of inflation and the Fed worried about that, you pretty much want to flip around all of these signals. So in the event that you have high inflation and high interest rates in the Federal Reserve, high, strong jobs data is actually perceived not as a positive, but as a negative. So you have to think about this in the context of what environment that you're in. So what we saw in 2022 was that the labor market was very, very strong, considerably increasing the inflation problem. And so every time we would get a good NFP report or good unemployment rate data, what usually would cause the stock market to rally actually caused the market to sell off because it meant that the Fed would continuously increase interest rates. This is the nuances of fundamental analysis, which makes this stuff a little bit complicated, and understandably, you may want to rewatch this video if you struggle with this concept. I would encourage encourage you to bookmark this video or to save it to your personal playlists to come back to it in the future. Now, all of this can be pretty complicated and understandably can cause some headaches. That is why on my team side, we've built a software tool that automates everything I just discussed with you guys. The EdgeFinder, which is our premium flagship product here at A1 Trading, allows us to track labor statistics and, more importantly, how they actually impact all of our charts through an algorithm that does everything I just mentioned automatically. Our system is tracking not just economic data that pertains to labor statistics like unemployment rate, wage growth, and NFP, but also more jobs data like the JOLTS job opening statistics, the ADP number, the jobless claims that come out weekly, and of course, inflation statistics and much, much more. If you're interested in exploring the full list of features that the EdgeFinder has, I would encourage you to check out the video in the top right hand of your screen right now. It is an ultimate guide to how you can use this tool, or you can head over to a1trading.com/edgefinder for more information on this tool. Fundamental analysis is a very powerful way to track what's happening in markets and to spot economic trends, but it can be overwhelming. And so we've built tools to help automate this process to study what is actually showing up in the economic data without having to remember every little bit and nuance of what we just discussed. What you'll see is that the NFP report is displayed here, and when we hover over, we can see historically all the key data that has been coming in for the NFP report. We have the actual data versus the forecast. We also have previous numbers and even revisions to the data that come in over time, plotted automatically for our users. We also have key statistics like the unemployment rate statistics, the weekly jobless claims or unemployment claims, JOLTS job openings, and even wage growth statistics on a year-over-year basis for you to better track all of this economic data in one single place. If you head over to our website, a1trading.com, you can also find the tour page under our menu button. Just click tutorials and you can read about the full list of features that our software tool incorporates. We have a dedicated team that continuously improves this tool to make fundamental analysis easier to approach for the everyday trader. Not just hedge funds and institutions are using fundamental analysis anymore. Nowadays, the average retail trader can take advantage of some of these economic trends simply by utilizing the correct tools in order to actually do so. So check out the EdgeFinder on our website, a1trading.com. If you'd like to learn more about fundamental analysis, I have a full playlist called Fundamental Analysis Explained on my YouTube channel. I'll have that pop up on the screen right now so that you can click into that playlist and find more useful tools, features, and explanations for key fundamental analysis topics. Thank you for watching.